Bloomberg Audio Studios.
Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Charlie Paladin for Doug Krisner this week. South Korea's brief lurch to martial law this week spooked markets, but rapid action by officials to restore democratic norms and reassure investors has limited the damage, at least for now. For more, we heard from Victoria Fernandez, chief market strategist at Crossmark Global Investments, and she spoke to Bloomberg's Sherry An and Heidi Stroud-Watts.
Does this give us an indication that perhaps markets and investors have underpriced the risk of political fragmentation more broadly, particularly as 2025 holds so much uncertainty?
Yeah, there's definitely been a lot of volatility in markets related to the issues that we've seen. Some of them are things that we were expecting. Some have been quite unexpected. And, we talked at the beginning of the year about how many countries around the world would have shifts in their leadership and in their governments, and how that could really make a change for policies and for markets. And I think we've seen that. Unfortunately, some of the things like we've seen in South Korea and like we have seen in France have caused some volatility elements, but they have stabilized somewhat. We look at South Korea, the markets obviously took a nosedive right after martial law was declared, but as that was brought back, we've seen them start to stabilize. We've seen central banks step in and put some stabilization and some liquidity components in there to help stabilize that. But again, any kind of political element causes concern and causes uncertainty. That's going to make the markets react accordingly.
Victoria, what do you make of all of the measures that we've seen so far from financial authorities? I spoke to the finance minister yesterday who was saying he could implement more measures if needed. Do you think it will come to that? And what are the expectations of how the market turmoil will unfold given that we're headed towards that impeachment vote?
Yeah, there have been some stabilization measures that have been put in place, and there are liquidity provisions that are there for the equity markets. We've seen stabilization funds get implemented both for the equity market, I think it's like 10 trillion won, as well as for the bond market. And we've even seen some liquidity elements come in terms of foreign currency repos to help with the FX markets as well. So I feel like the markets have some stabilization effects that are in place. That should help tremendously. It's the same type of thing we saw in the U.S. when we had regional banks start to fail. We had the central bank step in with a lot of liquidity measures to help support that. You're seeing the same thing here. So I think you are okay for right now. As the impeachment vote gets closer, obviously there could be some turmoil there. You've had a lot of people come out and say this could actually be a buying opportunity in South Korea because looking longer term, things should stabilize pretty quickly once the government is put back in place. We'll have to see. We can't see into the future, but it seems like the central bank is ready to tackle whatever they may see.
Yeah, opposition leader Lee Jae-myung telling me yesterday that investors should actually buy the dip. But Victoria, relatively speaking, though, given the ongoing political uncertainty here, what are some of the markets that you would be more encouraged by in the next few months relative to South Korea?
So obviously the U.S. market has had a lot of strength associated with it. There's a lot of seasonality serving as a tailwind for the equity markets in the U.S. And with the new administration coming in January, that seems to be much more business oriented, that would be advantageous in regards to tax cuts for consumers and for corporations, with deregulation elements, probably something that we're going to see. Then I think that the U.S. market has a tailwind at its back in order to help it continue to do well as long as inflation remains contained. We know that tariffs is going to be an issue globally. I think we have to separate tariffs from the U.S. as it relates to China and the rest of the world. As Bessent was nominated for Treasury Secretary this past week, you saw the repercussions in regards to tariffs globally, the element of that come back a little bit, and that was a positive for the market I think that's different with China. That is something that President-elect Trump can do somewhat unilaterally coming in. So I would stay away from those markets, and I would look more towards European and U.S. markets. Europe, I know, has been struggling, but if you look at the French consumer, even with everything that's going on there, France being the second largest euro area economy, the consumer is spending. Real spending is up about 2.4% year over year. Their savings is going higher. Wages are strong. So I think you can find some elements probably there that would do well also.
Victoria, of course, we're heading into payrolls day in the US. Victoria, what are your expectations for this economy and really where this rally goes from here, right? That leadership of the Mag 7, of tech record highs. Can we push further or can we broaden?
Well, hopefully, Heidi, we're broadening. That's what we want to see in order to have a sustainable rally. When you look at tech, you really have to look at it separately, kind of separate out the semis. They have been underperforming tremendously. They have the least amount of their constituents in that sector that are above their 20-day highs. So semis are really struggling, but you could look elsewhere in tech, things associated with AI as well, and utilities where you're going to be looking for energy associated with AI. Those could be areas that start to have some leadership. Financials obviously is an area that we have liked for a long time with the steepening of the yield curve, and we think you'll continue to see the momentum in that sector go forward. But jobs are going to be critical. I don't think an upside surprise will upset things, but if the numbers are really low, that could mean the Fed cuts rates even quicker than what people anticipate.
Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments, speaking to Bloomberg's Sherry An and Heidi Straub-Watts. Welcome back to the Daybreak Asia podcast. I'm Charlie Pellet. Doug Krisner has the week off. Asian equities tracked a drop in U.S. shares ahead of jobs data that may help shape the direction of the Federal Reserve's policy path later this month. Earlier, we heard from Nomura CIO and head of Discretionary portfolio manager Gareth Nicholson. He spoke with Bloomberg's David Inglis and Annabelle Drulers.
Gareth, good morning. I'll get straight to it. You guys don't think they're going to cut next week?
No, we don't. And we think the jobs data is going to be, a bit of Goldilocks, which is great. I mean, investors want Goldilocks. We like that. We don't want it too hot. We don't want it too cold. We don't want it too predictable. There's no risk. We don't want it too unpredictable. There's too much fear. We're going to get a 200-odd, job number, which will suggest to us that the Fed thinks the market is strong enough to be patient. They're going to wait to see a little bit more reaction from the new president coming in. They will keep their options open. That's constructive for equity markets. That's status quo. We think this is going to be a decent print for markets to continue the momentum.
So if we don't get that cut then later this month, what's your expectations around 2025 then? We still kind of stay high for longer?
We're going to remain higher than we have been for the last few years, for sure. We see 2 cuts for next year. We believe that gives the Fed the optionality that if some of the policy is a lot more inflationary than maybe expected, they can react. If it's not as much, then they can look to normalize to a terminal rate, which is more acceptable. And with regards to that, that's why we're seeing probably 2 cuts for the whole of 2025 in the US, unlike places like Europe where we expect more.
Gareth, on that point, I think we're headed for another record year for the S&P. It's just in terms of the actual level and the number of times we've been, clocking in new highs. Why even bother looking anywhere else, to be honest, Gareth?
David, it's a great question, and some question that I suppose investors have been asking for a number of years, right? You could have bought tech a while ago, close your eyes, and be pretty happy. But as investors, we've got to think about where's this predictable income going to come from. We know that tech is part of our daily lives, so tech S&P will continue to be a big driver of performance going forward. It's not going to disappear. But at these kind of levels, is there a probability that we could see a turnaround slowdown in growth? Is there a probability that tech is just overdone? Yes, it's low. It's more like a grey swan than a black swan, but there is this risk. So we do need to look to diversify. We do need to look at where there's other avenues of growth, just in case. Maybe not the majority of the portfolio, but definitely looking to move some out into areas that are going to give you growth, are going to give you also predictable income.
So what does that? What gives you growth with predictable income? Where else are you looking at?
Well, there's a number of different ways, but I think two offhand. One would be, and they're both actually reliant on a lot to do with the new administration coming in. One would be the art of the deal, would be we know that in the Trump era we're going to see more deal making. We think this is going to be interesting, particularly for the private equity market, and particularly in the secondaries. Secondaries have a little bit more visibility of the deals. They're looking at the last stretch of the race, and we think that's going to give you some more predictable growth. We also like, even though there's a lot of shifting with policy narrative, we like things like long-term infrastructure, private infrastructure, looking at decarbonization, digitalization, deglobalization. These things are not going to get affected by 4 years. They're 30-year projects. So again, those are nice, predictable incomes, low single digits, low double digits, high single digits. That's a comfortable income at the moment.
Yeah, Gareth, it's part of your almost 100-page report on the stuff to look out for next year. That's almost 1 page for every 3 days of 2025, which I think we'll unpack a bit later on. Just very quickly, I want to ask you about Korea. The notion certainly when you look at markets, which really have been stable to be fair compared to where we were right before this, the whole drama, is the value up program in Korea might be at risk. Is that something I should be worried about?
Yeah, Korea, we didn't expect what's happened recently, but we have been underweight both the bonds and the equities. The bonds because they've just been trading so incredibly tight, particularly the dollar bonds. The equity because of the tariff fears, because of some of the valuation, because some of the sectors that, majority of the index is in, we haven't really seen the value there. This has really shaken sentiment, shaken confidence. We're not going to see the same sort of tourism, same sort of support for a little while. So this gets our focus back on the space. Once we see a little bit more predictability of where it's going, I think the valuations will be more compelling. But at the moment, this is a wait and see. This is not an area where we would diversify out of the US, for instance, or Japan, or even Singapore to go into Korea just yet with regards to equities.
Gareth, if we don't speak to you again, Happy New Year. It's always obvious. We value, of course, the inside CIO and head of discretionary portfolio management there at Nomura.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.